Good afternoon, everybody. I'm happy to be here. Thank you very much. And I want to thank you all for all your very nice comments and remarks. And we're going to start with part number 3 about price behavior. A couple of questions that I want to answer them. I will answer all these questions after the presentation so that everybody can see we have time to do the presentation, and then I'll answer all your questions. Okay? Today we're doing the how to identify the risk. How can, based on price behavior, we can see the emotions of traders, and how we can trade around these emotions by identifying how these traders are going to behave. Because when we are trading the other trader. I want to see where the other trader is going to buy, where he's going to sell, and I'm trying to anticipate his action so that I am in the trade before he gets in, or before the majority of the other traders gets in. And then we're going to see some price points on the chart so that we can identify buy and sell, and use these price points as our buy and sell indicators. We also have 2 market conditions that we have to cover. One is the range bound, trading the sideways market, and one is to identify the reversals or the trend change. So hopefully we'll do today the range bound market, and on next week we will do the reversal. And I'm going to show you live trades today about the range bound and how we can identify these points. Now, in a range bound market, you would see that if we have our 2 areas of support and resistance, you would see that the prices are starting from support and they bounce up and they start moving up and they get to the resistance area. This move here from the support to the upside is considered a small trend. It is considered a small momentum move, because at the support level, this is where the bias of the market changes. So the market is coming down. It comes to what we call or identify as a support area, and the buying comes in, and then the market begins to rally to the upside. In that rally, the market is strong, and we do have some momentum going to the upside. And even though it is between support and resistance, yet still that move from support all the way up to where it reaches resistance, it is considered a small trend. It is considered a small trend within the sideways pattern, or within the range bound between support and resistance. Once it begins to come near the resistance area, this is where the traders identify that this is a resistance area, and they begin to do some selling. At that moment, where you see the successive lower closes, these are indecision points. They do not know if the market is going to break through the resistance and go up, nor do they know that the market for sure is going to reverse and to come down. At this area here, where we're having those weak closes, this is where the market begins to top. You will never, it is very hard, very rare, when you see that the market reaches the resistance point and then it reverses on a dime and it turns down in a V shape and it comes down. Now, what is the psychology behind this? When the market bounces off support, there is a lot of buying coming in, there is a lot of short covering coming in, and right here where you see this last bar, the traders are not sure which way the market is going, but the short-term bias is to the upside. Now, we are all traders, and when we trade, we have to do 2 things. First, we have to take the high probability trade by identifying which way is the most probable way the prices will go. And based on what we see right here on this chart, it looks like the prices has been going up. It is making higher highs. It is making strong closes. It's closing near the high of the price bars. And at this area, it gets into a sideways move. Now, one of you gentlemen, Point Tom was asking, is after a momentum high, what happens after a momentum high at this area? Is this a trend reversal or the prices are going to continue to the upside? Well, the reality is after a big momentum area, the market comes into what we call an equilibrium zone or a pause. That pause could be the beginning of a turnaround if the market is in a sideways move, or it could be a pause where a new set of demand comes in and then the prices break to move to a higher area. At this point, the picture is not completely clear. So how can we identify or get some clarity of which way the market is going? The way we get this clarity is that we put ourselves, and that is very important, that is key. If you are out of the market, if you are not in a trade, the most important thing that you should do is put yourself in the shoes of the trader that is making the most money and act as if you are that trader. Okay? Can you hear, Splau? Now, so if the market is going up and it's pushing higher, and all of us did buy it over here at the low, then we are trailing our stop behind the price. So we are going to place our stops right below the low of those days because we are long-term traders, and we are going to say, if I am long on this day and I'm expecting that the prices to go higher, then the most logical place for me to place my stop is below the low of the day, because the low of the day has been the lowest price point that they were able to push the price towards on that day. That was the lowest price, and then the market turned around and pushed and made the high or closed higher. So putting my stops below that low is the most logical place for me to place my stop as a professional trader, because I must control my risk. And when I'm placing my stop, I'm going to discuss the stops in a minute. There are three kinds of stops. I'm going to discuss those three kinds of stops in a minute. So right there, I'm placing my stops logically below the low of each day. And on the following day, so on day one, we are all placing our stops below here. On the second day, a second group of traders are jumping in to buy because they still believe that the trend is to the upside, and they also place their stops below the low of the day. And then on day three, another group of traders come in, and now we have multiple days, and each day we can think that we can, if we are going to use an imaginary number, we can say on each day, let's say there is 1,000 traders that go long. So below this, I would have 1,000 orders to sell at the market to get below the prices come here. On day number two, I would have twice as much the number of traders, so I'll have 2,000 orders, let's say, below day number two. And when the price on day number three, a third group of traders are now convinced, because the prices now are moving sideways at the top of the range, that this could be, point man, that this could be a price acceptance zone, and this is an equilibrium zone, and they're expecting that the price is to go higher. So 3 times the normal average number of traders are going to go long, and they're placing their stops right below these lows. And that is your line. As soon as the prices come down and take out these lows, all these sell stops are triggered, and you begin to get the continuous weakness into the price, closing at the low of the day and pushing it all the way down, closing weaker and weaker and weaker until it comes back down to the support area, and then the buying begins to come in, and now every time they are still selling it, the winners, the ones that are making money in this case, they are selling, and now they're putting their stops above the highs of the day. So above the highs of the days, these are your buy stops, and if the prices go above the high of the day, then we're going to get the break, and the prices should reverse and start going up. So in a sideways market, once we perceive or we can identify what we can think, let's say that this is a price point as resistance. Let's say that the price I have this horizontal line as resistance, let's say at 100. Then when the prices reach the 100, I am not going to sell immediately. I am going to witness now at this area, where will the traders that have taken the journey from the previous support all the way up, where will they place their exits? Where will they go out of their trades, either to take profits or to decide that we had enough, or we came in late into the trade and we're going to get out of the trade? The most technical place to place your stops is below the prior day's low, and vice versa on the daily highs. Now, I'm going to show you exactly this setup in today's trading, in trades that we took this morning, and I will explain, because so let's go to the chart. This is an actual trade. Okay, good. This is an actual trade that we took this morning, and this is how you have to set up your trading platform. When you are trading, you have to set up your platform in a specific way. Okay? So on the right hand side of the screen, I have my daily chart. And as you remember when we spoke, the first thing, the most important thing, the number one thing that you have to do while you're trading, especially in using the price behavior, is to identify the market condition. I'm going to expand it in a minute, Mary. Is to identify the market condition. So if you look at the daily chart on the right hand side, you can see that we have big momentum bars. Well, I'm having the cursor. That's the daily chart. So that tells me that look at the chart right now, and this is what we have here. So as you see here, you got this big momentum move, exactly like I showed you on the PowerPoint. And then we had 1, 2, 3 days, and they're having slightly weaker closes. So if it's slightly weaker closes, this could be either if the prices come down and take out these lows, because the guys that are long from here, are placing their stops below these lows. And then when the prices pushes higher, they move their stop below this other day. And they keep on. But at this point, Man and Jason, we don't know if this thing is going to break to the upside or it is going to reverse and come down. But the overriding move is this momentum, and now we are we describe what we see to ourselves, because that's the rule. Trade what you see, not what you think. Is this now, I have momentum, and this is a sideways equilibrium point, then one of two things. If it takes out the low and it trades below the low, then it is going to come down, and that is my reversal point, and I can go short. This will be a sideways pattern, and this momentum would have failed. And if it takes out the high, then that would be a breakout and a continuation of momentum. This is where we identify the beginning of a reversal. So I'm going to put this, and I'm going to, let me take out this line so you can see. I'm going to make this a sienna color so that you can see. And above the high, right there, I'm going to make that sienna also so that you can see what I'm talking about. And now I have a situation in the market. I have momentum that has been followed by a sideways pattern, and it could turn around. So at that point, I don't have a clarity which way it will go. The high probability, wait guys with your questions, because I don't want to, no, hold on, let me finish. I will answer all your questions, and then I'm going to open it for questions and answers. So I don't want to lose my track of thought, okay? And then, because I teach you everything here live. I mean, this is today, okay? I don't give you PowerPoint presentation. I'm showing you this stuff live, and I will show you, we actually took this trade this morning, live, and I'll show you, okay? So, at this point here, I have two situations. This could be a change to come down, so I have my plan. I'm going to go short below 147.45, and if it breaks above 149.29, then that will be the continuation of momentum. And my rule here, momentum precedes price, so the high probability is that it's going to fly to the upside. Now, when you are trading, as I said, you always have to keep your daily chart like this on your right-hand side of the screen. Why? Because, forgive me for, I'm going to say something for a lack of a better term, this keeps us honest with our interpretation of the chart and which way the prices should go. I see momentum. I see 3 days pausing over here. The rule is that pause is not a trend change. That is merely a pause. It's a resting place. And only it will be a reversal if it takes out the low and it trades below 147.45. As long as it's above these lows, this means that there are more buying coming in, and they are placing their stops, their sell stops below the lows. So my buying plan, if it gets above 149.29, I'm going to be a buyer. That big time frame keeps me honest. Now we move to this shorter time frame, and as you see here, this is the 149.29. I just approximated. The real number is 149.11. So let me put this 11 so that I don't mix you up. Okay, so that's exactly the high of the day, the 2 daily high, right there, 149. And 1 second, I'm going to show you this. This was this morning's trade. So right here, I'm coming into the London session. This is my London session. This is the opening of London session. There's 2 lines. And right there, you see this is the 149, which is the breakout point that I took from the daily chart. And this is how we take a price point as a technical indicator to buy or to sell. If it's above 149.11, then I am going to be a buyer. And of course, we have, this is the top of the range. So if it gets above that, this means that I'm just going to hide this. I'm just putting the 2 charts side by side so that you can see what. So this is, we're coming into the open of London this morning in a second. right there. This is here. This is at, as you can see, this is 8 o'clock, 8:20 in the morning this morning in London. The prices are above the 149.12, which is above the breakout over here on the daily chart. So let's put the pieces of the puzzle together and decide on a trade. I have momentum followed by a pause. Now the prices, rather than taking out the lows, now they're taking out the highs. So momentum precedes price. I'm breaking above the high after a respite place. Then I am going to buy right at a worst case scenario. You're going to buy at 149.20. All right? And that is your trade. That's why you always have to take the price point from the daily, just put another line like this. So I have 149.11. You take that price point and put it on your, like that. So now you know what you're looking for right there. So this is my 149.11. You put the same price point on your intraday chart and you take the trade. And that is your trade for today. That move, guys, that's in the pound yen today. It did work well. I mean, and this is, I'm going to show you something. These are live trades, and everything I show you is what we do in the trade. That is the trade that we bought 5 lots right there. As soon as it went above, everything I'm teaching you, we do live in our trading room. We take all these trades live, so we're not giving you. I'm not giving you a presentation. This is actual live trades. We took those 5 lots right there, and then you get into the trade and you take it all the way. Yes, we do a course in this. I will tell you all that stuff in the after the presentation. And as you see, on the way up, that is now your new momentum high. You're still looking for higher highs. And now, if I'm going now to push the daily chart a little bit, you begin to see that there is momentum coming in. Once you see this momentum and you see it above those highs, you don't need to take profit. Stay with the trade. Let that baby go. And where will it go? It will go back to the 151.50, which is a prior significant point, which we're going to get into that in a second. Every price point of the chart, people tell you that the prices are, doesn't make sense, and it's, I don't see it. If you identify these buy points and sell points like what we do here, and we teach all that stuff in the course, in the class, in Spyglass, by the time you're done, this chart becomes like an open book. You can read it and know exactly what you're doing. That ambiguity is gone. It's ambiguous because people don't know what to look for. And now it's coming into there, and it keeps on going, and it keeps on going. And look here, this is the 151 number. Right there, that is the 151, and this is where it stops, right at it. Because these are the significant points. And that is your trade. Now, these are the trades that when we are taking the auto, these are the positions that we took this morning. This is the euro yen. What we do is we automate, we do our portfolio selection. Okay. And then we put the ones that, these are the positions. I left them running for you so that you can see exactly what, this is automated. Okay. Exactly based on the rules. And I am teaching you. Okay, I can refresh it again. Okay. All right. No, there's a green. This is the open positions that we have right now. While I'm talking, 1 contract each. Okay, and it's open, and the most important thing, guys, that you see. Forget the money. The money is important. We all like to see the money. The money is good. But what you want to see is that you have 4 positions, and the 4 positions are green. That's more important than the money. you have 4 positions open and the 4 of them are green. And all of them is based on the same set of rules. These are the trades that we took based on the... So, in order, going back, do you see my chart now? Do you see my chart? Okay. So what we do now is, as I said, we identify we take the daily chart and find the significant price points where we are going to buy and sell and use them as indicators. We take these price points, put them on the intraday chart, and we begin to trade. Okay, somebody might say, let's see another example. I'll put another one for you. Again, we're trying to do the range-bound market. We're trying to do the trending. And at the moment of decision, the market is either trending up or it is trending down. And then I have to have a moment of decision. So before I go to another pair, take a look at this one here on the daily chart. And I'm going to take you to the down move. As soon as the prices broke below the low, you got this momentum move coming down. And then you start getting an alternating closes. Some weak close, some strong close, but there is no continuation of momentum to the downside. And you can see that we're getting stronger buys. So what's happening is, what is the price behavior here? How can I make sense out of this? Is this thing going to go down, or is it going to reverse and start flying up? Okay, so the first thing I do is what? We put ourselves in the position of the trader that is making the most money. So look at the daily chart here. Who's the one that's making the most money? The ones that are short, that took this to the downside and they're making money. So if I'm short and I have taken it from 149, it is now trading at 142, I am up 700 pips. I'm up 7 grand. Nobody likes to give his money back. A trader, a human being, and I'm sure all of you will agree with what I'm going to say now, we are more scared and we are more fearful about giving back $1 of our profits than losing $1 from our equity. When you take a trade and you put your stop and you say, I'm risking $100, and the market goes against you until it gets to, it's against you for $99, you're very courageous because your stop has not been hit. But if you're making $1,000 and it goes back against you, or you're making $100 and it goes back against you, $1 or $2, we're sitting with our fingers on the mouse, itching to take our profits. That's a normal behavior. That's a typical human behavior. So the trader that is making more money is going to be the scariest person, is going to be the first one to get out of the market. So how will this guy get out of the market? The short has to buy. Okay, so I mean now these take profit, they're going to buy. Now I have to ask myself my second question. If I was in his shoes and I want to buy, where will I buy? Where will I say I had enough? I'm not going to give back a penny out of my profit. I will take, for example, this high, and I'm going to say I'm going to get my stop and put it right there. And that will be my buy stops over here. And as soon as the prices get above the 143, every guy that made this money is going to get to buy to get out. And the bigger this momentum move, guys, the bigger that momentum move, the stronger the reversal to the other side. Why? Because it's a huge number of traders, and a huge number of traders are going to be taking profit, and you'll get a huge move to the upside. And look at the first break above the 143. Look at that. From 143 to 147, 400 pips in one day. Why? It is a typical price behavior. It is a typical human behavior. and everybody is trying to scramble to cover his shorts, and the best trade that you pray to God that you catch every single day, you get down on your knees and say, God, please let me catch one of those trades, is a short covering rally. These are the number one trade that you want to be in. It is the best trade in the world. And once you know that you are in a short covering rally based on the momentum after a big move and you get this reversal, you get into the trade, you buy, you stand up, and you sit on your hand so you do not touch the mouse, and let that baby run. So that is basically looking at the trending market. Now we get into a sideways market. We still, based if I have my trend on the daily chart, I'm still looking for it to continue to the downside. Only when it breaks above a reference point which we have identified together as the reversal. And we know now the typical behavior of the traders that are making money. In this case, they are covering their shorts. So if they're covering their shorts, they are scrambling to get out. And that is the result of the scrambling. And I want to be the first one in. As soon as it gets above 143.90, 09, I'm a buyer. I'll show you another example. That's the pound Swiss. And you'll see exactly we do that every day. And that's what we do in the Sunday session. When we are planning our Sunday session every week, we identify these points. So every Sunday, I mean, the invitation that we have extended to you as members of FX Street, we welcome you all to our Sunday session. We do this every Sunday to plan our trades for the following week. So I think, gentleman, Point Man was asking me this before the session began, are the price points that we have is for the week? Yes. This is the price that we identified on Sunday that we're going to buy the pound Swiss above 165.27. Once a break, we had this momentum, and that's it. You're up already now, 200. I will get to the stops in a second. Thank you for bringing it up, Leonardo. I'll get the stops in a second. So now, this is your buy point. And as you see here, Point Man, it came back and it held the 165.27. This makes it very strong point, and you want to let it go. Now, where we get to the second point now, where do we place our stops? There are three kinds of stops. There are three kinds of stops. Okay? And they are, and I'm gonna give you a quiz. That is what we call the money stop. So let's say somebody says I'm going to risk $100 or $1,000. There is the technical stop, where you place it in a technical location. And there is the third one, which we call the time stop. Okay, I just want you to a quick poll. Which one of those three is the most important one? The money stop, how much you're going to bet on this trade, the technical spot, putting it in location, and the time stop. Okay, quick guys, use one letter, just one letter. Technical, time, TC time, quick, okay. Technical, money stop, okay, alright. Money, okay, good, keep on going. Alright. Okay, Sheena. Okay, let me tell you guys, the most important stop, and I'll give you them in order. The number one stop that you should be considering is the time stop. The number two is the technical stop. Last is your money stop. Why? If I buy based on identifying a, not time decay, Paulie, time stop. And I'll give you the rule of the time stop in a second. So if I take a trade based on a price point on the rules of price behavior, then I have to ask myself two questions. If the prices are supposed to go above, like here, for example, if you guys who were with us on Sunday, most of you were with us on Sunday, we had a big crowd on Sunday, our buying point was above 165.27. So the rule is if it gets above 160.27, I'm going to be a buyer. So my expectation is, I have to ask myself, what is my expectation? And then the second question I ask myself is the prices behaving as per my expectation? And these are yes or no questions. There is no ambiguity. There is no description. It is behaving. Yes, I'm staying in the trade. It is not. I'm out. So if it gets above 65.27, I'm expecting that all these short guys are going to cover their shorts. So if the prices come above 65.27, I'm expecting a breakout. Did I get the breakout? Yes. Then I'm staying with the trade. But if I get a breakout and I don't get a momentum, I don't get a short covering rally, I do not see that all these guys are scrambling to get out, then I am going to say, okay, it might take a little bit longer. The rule of thumb is 4 times your price bar. The rule of thumb is, let's say you're trading on a 15-minute bar. Again, this is not exactly 4, but an average of 4. I mean, that is the number 4 will give you a statistical edge. Okay? So, for example, take a look at this chart. The price behavior works. You'll get 1, 2, 3, 4 bars, maybe a fifth, and then a pause. 1, 2, 3, and then a pause. 1, 2, 3, 4, a pause. 1, 2, 3, 4, and then a pause. So you always get between 4 and 5 price bars into the direction of the momentum, followed by a pause. So if I get into the trade, and then for 4 bars nothing happens, then I'm closing that trade. Why? Because a lot of people that are trading in a similar fashion that I am have watched the entry point, have taken the entry point, and yet there has been no follow through to the upside. So what's going to happen is that these guys now are going to second guess themselves. They're going to say, oops, we made a mistake. There is no momentum. We're not following, the prices is not behaving as we expect it to have behaved. We don't see the breakout. Then we might as well get out of the trade. And that getting out, we give them like 4 times the time frame that you guys are trading. So if it's 4, 5, I mean, you don't have to be, after 4 bars, you begin to look. Okay? So if you're trading an hourly bar, you wait after 4 hours, and if it doesn't move, you begin now to start questioning getting out. You give it 5th, but not more than 6. You're done. Okay? The same thing with the daily. You wait for 4 bars, 4 daily bars, and then boom, you're out. Okay? So the time stop is key. Otherwise, for example, if you remember, part of the trading rules is they say never short a dull market. You never ever want to go short a market which is dull. It's not going down. A dull market is a reversal market. You never ever want to short a dull market. You go short and it goes nowhere. Get out and get out fast. Okay? Now, the second stop is your technical stop. And your technical stop is you have to place your stop on a location. It has to have a technical location on the chart. That's my stop below this. If I'm going to go short, I'm going to put my stop above the high. So you place your stops on a technical base. Last but not least is the money stop. I want to risk $100. I want to risk $200. I want to risk $300. That is the weakest of all stops, because it has no technical reference. If I am looking, let's say on average, a lot of people would say, I want to risk 25, let's say 50 pips. If I put something like an average true range, and I'm using an average true range just to give you because that's the average swing of a price bar, just use it as a reference number. And when you're using any indicators, guys, use the default number, which is 14. You don't want to curve it. So here, for example, my average swing on the daily bar, if I'm trading the daily pound Swiss, my average move swing is 150 pips. That's your money stop. That's the average swing between the high and the low for the last 14 days. So if you put a stop of 100 pips, the odds are you're going to get stopped out. So if you feel that 100 pips is more than what you can take, and you want to take the trade, cut your size. Instead of taking a whole one big lot, take 5 minis. Take 1 mini. So you still keep the dollar amount, but you put your stop in a technical place. If you do this, take your normal size and you put less than 150 pips, you might as well write a check to your broker and give him the 100 and save yourself the headache. All right? So it's 5:45, 4:45. We've got 15 minutes to go. So I'm going to do the reversal. So if anybody has any questions, let me know. Okay, and this I'm going to show you the auto. I left it open. I left all the positions open. Can you see it? Do you see the strategy page, guys? That is your positions, the system. I mean, the rules that we have taken, exactly the same rules I've explained to you. They are running, and if any of the rule is breaking, it will shut it down and get it. The key point that I want you to be trading, and I'm showing you this, is this. The most important thing, guys, is look at those positions. You got 1, 2, 3, 4, 5 positions. 5 out of 5 is green. There is no optimization. I'm not covering anything. I'm not formatting anything. What you see is that. And that's if you are trading anything. Even if you learn these rules if you learn, and that's what you're trading. If you have something that works for you 4 times out of 5, and you money manage yourself, this is how you want to be trading. This is how the money is made. All right. So now I'm going to open it to questions, and let's the Sunday session is we do this Sunday. I'm going to do the reversal on next Wednesday because it's and I promise you that by the end of next Wednesday you will all would have been able to pick the turning point of the Dow Jones, and I'll show you that. I will teach you by the end of the session next week that you will all become technicians, that you would have called out the turnaround in the Dow Jones in 2007. So let me answer the other questions. If there is economic news and economic reports, there is a specific way to trade those news, and they become what is known as news trades. So you don't set up these systems on them. They are traded in a different way. Okay? Yes, I teach the course Cool Spirit. Okay? So hold on a second. One moment. So I lost my phone. What was I saying, guys? Oh yeah, so if it's a news trade, you trade what we call trading the news. We have specific rules. I'm sorry. We trade the news in a specific, because I don't prepare this stuff, Desmond. I'm teaching you live so that you can, because the only way that you can learn how to trade is to see how the decision is made live, rather than I give you a PowerPoint I could have and I should have. Okay? Okay, the blue lines, this is all this stuff that you see here. This is part of the software that we have, which we have in Spyglass. All that stuff is part of the software, and the software is made out of 5 components. One is what we call the key lines. These are the yellow and they identify for us zones where we decide which way of the market we want to buy. So for example, above the yellow over here, I want to be a buyer. If it's above the yellow, short is not an option. If it's above the magenta, I want to buy. If it's above the blue, I want to buy. These are all different sessions. Okay? So these tells us these are intraday. The daily, there is something 180. So in those sessions, for example, right here, and you would see how many times it has been successful. I mean, that's what you want. You want an edge. This is how you get the edge. So above here, that is a buying decision. So selling is no longer an option. So here, you can buy or do nothing. Right there, you can buy or do nothing. Here, you can buy or do nothing. Selling is not an option. Okay, so now you're taking the high probability trade. Here you're taking the high probability trade. That's one component. Exactly, yes, absolutely. That's the short-term frame that we're using. We have also the long-term. I'll show it to you in a second. So the second component is this line that some of you are asking me about. What is this line? This is what we call a key line, market side. And the market side is not a moving average. It has nothing to do with that stuff. They are, as you see there, they are session unique. I mean, they get cut. It ends at the end of the session and it begins. It gives us if there is more buying coming in or there is more selling, and we try to identify that by seeing how many trades go on the bid and how many trades are going on the ask. And as long as the prices are above the market side, you want to be a buyer. So right here you have 2 decisions. Above the key line, you're a buyer. Above the market side, you also are a buyer. So there is 2 reasons to be long. Okay? And then we have those reference points and as you see the market side during the day, it acts as your intraday support and resistance. Once it breaks here, what does it mean? It means that the prices now have reversed. I will give you the risk reward in a sec. It has reversed. The market has changed its side. You want to go short right there, and as you move. So this is one day on the upside. This is the second day on the upside. Now, I explained to you the rules. Let me show you something. Hold on a second. I want to show you something. I'm going to put the strategy on now without any formatting, and we'll be trading the US, the yellow session. Okay, and I want you to see, look at this. So here we're buying, and it becomes the buy, and it gets below the market side, we should get out and reverse. Now watch this. Just takes a second because I turned it off. We have it on TradeStation, multi-charts FX. That is the setup that I was telling you. It took a buy over here. See that? It bought it at 165.80. And it kept on going, staying with the momentum until the momentum changed. And it closed the trade at 166, I think, 30. So that's 80 pips to the upside. As soon as it broke below the market side, and as you see what it says here, it says it made the lower low. It has failed. It broke the rules. Every trade is identified for you. Now we go short. So it takes it short, and then at the end of the session, it closes. So the same set of rules that I've explained to you, now you've witnessed it is done live. That trade by itself is 200 pips yesterday. in the New York session. Yes, it is. Yes, you can buy it from Spyglass, and we also teach you how to. We teach you the price behavior, how to trade with it, how to understand, to identify the significant points, so that you can. That will become your co-pilot, and you use it to get you into the trade, and it allows you to stay in 5 or 6 positions. You don't have to watch one shot automate and get you into the trades. And you can have 5 or 6 different pairs, and not just watching one pair at a time. So in the morning we choose which is the most pairs that are more likely to move, and this is part of our portfolio selection. And then we put them on the automated, and we take the trades. Okay. Now what else? I don't have an MT4, but the MT Trader 4 yet, but you can use it to trade with. No, I don't. But you can. I mean, I think I'm sure it's. I don't know who's your broker, but you can execute with TradeStation, and there is 100 brokers. There's something called Strategy Runner that it takes the signal, and you can execute. The reason we are using it mainly on TradeStation is that it has the cleanest set of data. They have a lot of good filters to filter the exotic moves, the big spikes and stuff like that, because you need something that gives you a dependable signal. Okay, so if you have a bad signal coming in, like you see on some other, not all, on some other data feeds, then I'm getting bad data. So, garbage in, garbage out. So I'd rather. So, but anyway, we have it on, as I said, on MetaTrader, not MetaTrader, on MultiCharts, TradeStation, and there is also MCFX. So there's a lot of software packages out there. What else? Somebody is asking, appointment. How do I identify that the retracement and uptrend has finished? So the trend is on. Okay, that's a good question. If you guys have any other questions, put them in. So right here, if you take a look at this chart, appointment, there's your trend, there's your momentum high, there's your higher high. Right here, is this a higher high? Guys, right there. Is this a higher high? It's not. I mean, the rule is momentum precedes price. I'm supposed to get a higher high. Right here, I did not get my higher high. That is a first failure of behaving in the proper fashion. So that failure is my first sign that there might be a trend change in action. It is not yet a trend change. It is not yet, it could be a pause. It's not yet a trend change. But as soon as it makes a lower low like here, right there, that is your trend change right here, and this is where you have to go short. Okay? And you take it short from here, and there is your trend. You guys are quiet today. Any other questions? You guys can hear me? Thanks, Anna. Yeah, you want to look at the cat? Sure. The Sunday session, you just go to Spyglass. I'll put and you just register, and we'll send you the password for the Sunday evening session. And it's 7 o'clock London time. Yes, we trade every day, live every single day on our trading desk, and this is where all our traders come in. So anyway, you can send us an email right there, and then it's spyglasstrading.co.uk. All right? Somebody was asking about the CAD. This is the CAD today. Okay, the guys, we will call it a day. If you have any questions, you got my email on there, and Maud has my email, and you can send us an email, and we will be happy to answer all your questions. So send us an email, and I'll answer because the time is running out. Okay, guys? Thank you very much.